Whether you're dividend investing, growth investing, trading, doing some sort of combo of all three, gambling, or just doing life itself, there is one thing, one life practice that really we must exercise. And should you actually master the craft of just this one life practice, I can only guarantee you far more success as an investor, which is really me now just telling you that you can make more money, whether that's through dividend income or just good old share price appreciation. Now, both in my book are more than acceptable. As someone who has now really come to understand the name of this whole investing game, which comes down to total return. Now, many of you may be thinking, yeah, right. Another far off guarantee from some wackadoodle YouTuber. To which I say to all of you, well, be my guest to think as you wish. But on the other hand, I never really offer up guarantees here on the channel, and I'm constantly telling others to actually run away from those who speak so boldly. But here's the deal, listen up. I'm not offering you a 10x opportunity, fool's gold, or a Bitcoin millionaire insider tip. I am here to simply tell you to basically not build your unintentional investment portfolio that you may be building. Now, many of you are doing exactly that, and you may even be building an unintentional life, because chances are, if you're building an unintentional investment portfolio, that actually stems from your life building habits, which then leads to an unintentional life. But that is an entirely different video altogether. However, what the heck am I even talking about here in terms of investing, and how does this all apply or translate to you? Or perhaps a better question we should be asking is, how do you go about building an unintentional versus intentional dividend portfolio? Well, it's really quite simple. First, you might be getting totally distracted by dividend yield, which results in what we in the dividend investing community call yield chasing. Secondly, you might be overloading your portfolio with any good stock out there that you see fit, and then you find that it slides into the red territory without any rhyme or reason, and you don't even know why you're invested in it. Or thirdly, you may be under the delusion, yes, delusion, that dividends are the way to financial freedom, as they're associated with passive income, and the more passive income you earn, obviously, the less you work and the freer you ultimately become. To some extent, that's true. But the only issue with all that is, while it sounds incredibly sexy as the ideal, it's actually going to take you boatloads, and I mean boatloads of cash invested to actually live off the dividends and actually achieve the dream you're looking for. You know, probably the fast cars, big houses, yachts, jets, beautiful women, the ticket to see the world, heck, so on and so forth here. But I just want to bring it all home right now, from one investor to another. I am here to say, do not get suckered in by all the hype. You need to practice self-control. This is easier said than done, but I just want you to totally avoid actually what most of you hear and see out there on, well, sites like this, YouTube, or even the bigger cats meow with the Jim Cramers of the world, because it really all is just noise. But listen up, because I want you to actually level up as an investor, truly. Therefore, I want you to start to practice self-control, which breaks down into awareness and patience. You see, self-control, or becoming aware and patient, if mastered, will ultimately allow you to think more like an investor and less like, well, yourself. I mean, we all always talk about the greats out there like Ray Dalio, Charlie Munger, or Buffett himself. But what all of these legends of Wall Street actually do and have in common, and I mean 10x or heck, even 100x better than us, is exercise patience while remaining hyper aware of trends and blind spots and overall just Wall Street stupidity. They are insanely self-aware. Don't believe me? Well, I want you to go pick up and read the book Richer, Wiser, Happier, or even my current read here, The Snowball. You'll hear it directly from the sources. But okay, let's talk about the investor out there who has no self-control. The investor who can't sit for one hot moment without triggering the buy now button, and who really has no idea what the heck they're actually investing into in terms of what the company does, but they're invested into it to actually reap the fruits of the high dividend yield. That's a lot of us out there. This investor is likely invested in, say, the Yield Max ETFs, or maybe they're playing it a little bit smarter and safer with an Aris Capital, or a Verizon, a Dow Chemical, or even a British American Tobacco. Not bad companies, but as you can see now, whether that's on the year or over the last 5 years, they haven't been delivering through on great performance, lackluster performance, honestly. But if you're out there and someone who truly understands the name of this game, well, you're going to go for companies with strong brand names, quality leadership teams, and most importantly, clean balance sheets. Sure, you might not get the reward of the dividend dopamine hits and all the dividends immediately, but eventually you're going to thank yourself for just being smart today. I mean, just sitting on the S&P will deliver better results and returns than seeking high dividend yielders. But then you can ultimately get into the Visas, Waste Managements, Home Depots, or McDonald's of the world to ultimately get an outstanding growth return rate all the way around. And now that requires you to literally just meet yourself as an investor, which is where your investor profile comes in. And I want to harp on this because in order to have self-control, to be aware and sit patiently with your investments, well, you need to know about yourself. Whether that's your goals, your age, how long you can actually remain invested in the stock market, if you really need the dividend cash flow now, or you can perhaps hold off for a bit. You might be fooling yourself. How well you can sit in the face of volatility. I mean, all of this matters. And it matters because of the number one rule of thumb. Buffett said it best here, so eloquently put, don't lose money. That's the number one rule. Now, many of you may be thinking he's referring to placing a trade, the stock plummeting, and of course, all of your capital just vanishing, which is the obvious case. But many of you probably aren't thinking about arguably an even greater loss. And it's terrible. It's a tragedy. It stems from opportunity cost. You see, your desire for cash flow right now today in high dividend stocks means risking the real potential growth and ROI of your future. I mean, let's just throw Verizon right back up. This is a golden goose opportunity for certain investors. I'm not denying that. But for the vast majority of us, especially if you're younger, well, it's not. It's simply not. You'll see that Verizon's performed quite well up on the year by over 5%. Better yet, take a look at that dividend yield, 6.6%. That screams money to my ears. However, if you click out to the 5-year view, I actually want you to really take note of this and understand that you have a 30% gut-wrenching loss. But say you understand your investor profile and you didn't get sucked into all the noise and, well, you just don't want to leave all this cash on the table. You can invest into United Health like I just did not too long ago. You could see that we have a powerful dividend stock on our hands. Yes, with a lower dividend yield, but that dividend is actually growing by over 40% on average per year, currently at 1.5%, but also a stock that's appreciated over 116% in that same 5-year period. What does this really mean in terms of money in your pocket? Because that's what matters. Well, if you invested $10,000 into Verizon 10 years ago because of that dividend and that dividend mindset and the allure of the whole thing, you haven't really have made much at $14,351 today. But let's say you went with United Health. We'd be talking about 21+% worth of an annual return rate as opposed to 3%. That grants you a nice $71,000+ in your pocket. So here I'm saying, again, to avoid all the hype, the noise, and the craze about dividend investing and cash flow now. Be patient, be aware, and instead, be the investor with self-control, exercising that awareness to understand your unique position in life at this moment in time to ultimately render the best, the wisest investment moves to accomplish your goals, all while practicing the patience to allow it all to work in your favor. Now, investors, let me know your thoughts on this. I'm super interested to know what you think. Am I on the money or way off base here when it comes to a well-rounded investor? And if you really want to come to understand some of the mistakes that I made, they're not pretty, I urge you to watch this video right here. Definitely be sure you're subscribed to the channel. But with all of that, investors, I'll catch you in the next video.